Ashish, good morning. Fantastic to have you back and thank you for joining us. What's happening in the market? I mean, I look at the Nifty and it looks like there is no problem in the world, but the minute I look at mid-cap stocks, small-cap stocks, the broader end of the market, it's not looking all that great.
Yeah, I think people are reacting to the experience of 2018, as far as small and mid caps are concerned. But I think I always tell my investors that, your level of confidence has nothing to do with your returns in future. I think selectively, wherever the performances are holding up, in fact, we have been advising people to invest relatively more in mid caps, to be honest.
What's been the mood at your AMC? Your AMC positioning is radically different. It is positioned around the fact that your fund managers believe in buying quality businesses. They believe in buying consumer dominated companies at a time when markets are rotating, which is cyclicals are making a comeback. Instead of retail bank, corporate banks are making a comeback. Consumer stocks are taking it slightly easy. What's been the messaging from your AMC and what is the feedback you're getting from your investors?
Yeah, so I think that at our end, it's at our end also. I mean, within the quality and the growth-oriented space. So for example, in our own portfolios over the last 1 year, within the corporate bank space, for example, within the private sector corporate banks, we ourselves have increased exposure. I think that's been happening through the last 1 year when we got a sense that there are certain significant management changes or there are certain governance changes, or for that matter, let us say we have seen the worst of the provisioning cycle. I think when we notice some of these changes, because we are not someone who would jump into trouble and then get at the deep end of value and then really wait for the tide to turn. That's not really our way of investing. We prefer to see early signs of improvement, or we prefer to see early signs of growth. So having said that, we ourselves in the last year or so have seen inclusion of private sector corporate facing banks. It's not something new, I am saying. Rightly or wrongly, it seems to be more of a consensus right now, but consensus doesn't have to necessarily be always wrong. So I think that is one change at our end. On your question, as far as consumer names are concerned, I think we still remain confident. I mean, with our style of investing, there can be times when prices do run ahead and then there can be time corrections. But as far as numbers are playing through, I don't see any reason why we should change our stance. It's not like we are wedded to any one stock or any one sector, but the point is, as far as numbers are coming through on the fundamental performance, I don't see any reason to change those positions. There's no point in reacting to share prices on a hindsight basis. So our conviction remains as far as the B2C businesses or consumer facing businesses are concerned. And I think in the next 6 to 9 months, given the political landscape and a lot of the things that are being discussed, I think they are more likely to get a fillip. On the other hand, even a lot of auto stocks from a long-term perspective, purely basis last couple of quarters of numbers, a lot of them are giving good entry opportunities. So conviction remains. Well, yes, last 1 year there has been a time correction, but that doesn't change anything for us.
Ashish, morning. There's expectation that the budget this time, as truncated a version as it may be and maybe vote on account, it's going to have a rather populist flavor, considering it's just a few months before the general elections. Do you sense there could be some material announcements which perhaps could push the rural growth up, which has been lagging for a while now?
Yeah, I think all the pronouncements, I mean, I think at a recent some conference or some recordings that I was myself going through, I think the finance minister also alluded to some kind of need for support, and it looks like more that these stuff like MSP etc. doesn't seem to be working effectively. So it looks like more a move towards doing some income transfer or some kind of scheme coming like that. I won't be surprised if that really happens. And I think it's not even new, I think barring 2014 when the situation was really bad, apart from that, I think most elections have been preceded by significant expansionary kind of announcements. And deficit always remains to be a concern, but my sense is that nobody stands up on a stage and says that the deficit will be busted. It's just that the way the arithmetic plays out is for all of us to see how it works.
So Ashish, simply put, what is it that you're advising, or viewing as an outlook for the markets into the first half of this year, that is in 2 elections, and post that?
Yeah. So my sense is that what we are looking at is 2 or 3 things. One, clearly, if you see the macros and if you see this whole trade war related thing, that seems to be softening up. The other thing is that the number of rate hikes that people have been factoring in the US, I think there seems to be a softening there. If you see, China seems to be priming for some kind of relief measures or something to pump up the economy, because they are witnessing significant slowdown. So I think compared to what we saw second half of last year, a lot of the things in the global scenario might be actually softening relative to what it was last year. Second is, oil prices seem to have settled. I mean, the volatility has at least come off, and they seem to have settled in that $60 kind of range, which is not bad for us. On the other hand, if you see at our end itself, my sense is, like we discussed, the budget will be expansionary, and I think RBI will be a bit more accommodative. That's the sense. So if you ask me, normally we are not, like Nikunj already mentioned, we kind of tend to hold our positions with a longish tenure. Our churn rates are pretty low, etc. Having said all of that, if you put a gun to my head on first half of the year, my sense is we are already in a pre-election rally, and I expect this to sustain given all the factors that I have highlighted. Talking of second part of the year, I think if there are no significant political hiccups, then I think that they should sustain, if you ask me. Even corporate numbers, I think selectively there has been improvement. I mean, they are not as bad as, or not really, nothing bad to really complain in a big way. I think the numbers have been reasonably good. So given that a lot of things have changed compared to where we were in the last quarter of last year, from there on I think a lot of improvements. So my sense is we are in a pre-election rally right now. I expect it to sustain going forward, and then one has to watch for the political landscape.
Okay. So Ashish, if a client walks up to you and say, Ashish, I've got a 3-year time frame, I can take a 10-15% volatility. Should I buy a large cap fund or should I buy a mid cap fund, or should I not buy both?
Yeah.
Focus on the last part also. Should I not buy both?
No.
Buy gold.
First is on a lighter note, everybody who looks to invest in equity, when they're about to sign up, they are always long-term investors. But I think, like you rightly pointed, everybody is a long-term investor, but the first sign of a 10-20% down and the long-term goes out of the window. So keeping that caveat, I think people should stick to their time horizons. And straight on your question, I would definitely want some component of mid-cap in it. I will definitely not say put it fully into large cap, because I think if you are going to now say that put it fully into large cap, then you are giving away a lot of hindsight bias, and I don't think that works in investing. My sense is, you pick between multi-cap, you pick between mid-cap, but I would say that 3 years should be more like 5-year horizon, and you should have at least half your money in mid-cap at this point in time. Because if you compare on a relative basis, and here we are talking stock picking, we are not making generic comments. The point is that in the last 2 to 3 years, a lot of the accidents happened in the large cap space. All the disappointments have been related to Nifty earnings, and the large cap index has held up pretty well. On the other hand, it's the small and mid cap which has been smashed out of shape, and if you're actually a stock picker, then there are quite a few companies who have not done badly to allow you some leeway for stock picking. So long story short is, I would definitely solicit investments at this point in time. I would definitely put half the money in mid cap. Only thing is, I have learned that it's not 3 years, it should be more like 5 years.
So closing comments, and I'm going to be inviting a lot of rod from my producer, because we've extended our appointment with you also. What's been the inflow and outflow position in last 3 months? Net inflows or net outflows?
So we are still witnessing net inflows, but the numbers are flagging off, honestly speaking. I mean, there has been a significant decline. I mean, the balanced fund category is pretty much heading towards zero. And I think that has got to do with the decline in quantum of dividends and the fact that dividends are now taxed. And the overall return has not been that great in the last 1 year. So I think the balanced category is something which is witnessing practically zero flows on a net basis. Diversified equity is holding up. We are seeing net positive numbers as of yet. But if you see last month, say December, we ended with 6,300 crore net flow, in which balanced was practically zero. Equity was about, NFOs were about 2,000 crores. NFOs are very opportunistic. I don't give much credit for that. So I think that the core equity number was more like 4,500 to 5,000 crore kind of number, and that is below your actual SIP input which comes every month. So I would say as we speak right now, definitely net flow numbers are flagging off. If the whole industry does 4,000-5,000 crore in the business as usual kind of areas, then clearly there are some schemes on the margins which are witnessing an outflow right now. This is a result of last 1 year. I think people still live in a lot of hindsight bias. So if last 1 year return is not great, then that reduces people's confidence. Like I started off saying, confidence has nothing to do with future return. And the second thing is that I think the distribution industry is going through some adjustment. You know that there are a lot of changes in the way commissions are paid out and the way distribution is remunerated. So I think there is a phase of adjustment going on right now.
Ashish, great having you this morning. Thanks very much for taking out the time to speak.